Right now, somewhere in Australia, two people are sitting down to do their finances. One earns $45,000 a year. The other earns $180,000. And they're following the exact same strategy. That's not just a mistake. It's costing them both tens of thousands of dollars. Because here's the thing nobody tells you. The best financial move you can make depends entirely on what you earn. A strategy that's brilliant at $45,000 becomes completely useless, sometimes even damaging, at $180,000. Today, I'm breaking it all down. Whatever you earn right now in Australia, I'm going to tell you exactly what to do with it. No fluff, just the moves that actually work. Section 1. Know your bracket. Before we talk strategy, you need to know the playing field. Here's how Australia's tax brackets look for the 2025 to 2026 financial year. $0 to $18,200. You pay nothing, zero tax. $18,201 to $45,000, 16 cents for every dollar. $45,001 to $135,000, 30 cents per dollar. $135,001 to $190,000, 37 cents. Above $190,000, 45 cents, plus the 2% Medicare levy on everything. That top rate, 47 cents in every dollar. Goes straight to the government before you even see it. Here's why this matters. Every strategy I'm about to share is designed to work within these brackets, not against them. The goal is to keep as much of your money as legally possible, then deploy it where it grows fastest. Let's start from the bottom and work our way up. Section 2. Earning under $50,000. Build the floor. If you're earning under $50,000, I want you to ignore everything you've heard about investing in shares, buying property, or building passive income. Not yet. Right now, your one job is to build a financial floor beneath you. That means an emergency fund, 3 months of essential living expenses sitting in a high-interest savings account, rent, food, utilities. That's it. This single move stops you from going into debt every time life throws a curveball, and it will. Now, here's where it gets interesting. At this income level, the government is actually trying to help you build wealth. Most people just don't know about it. The Super Co-contribution. If your total income is $47,488 or less in 2025 to 2026, and you put $1,000 of your own after-tax money into your super, the government will hand you up to $500 back. That's a 50% instant return. You will never find that anywhere else. Not in shares, not in property, nowhere. The low-income super tax offset. Earn $37,000 or less? The government will refund up to $500 of the tax your employer already paid on your super contributions. You don't even have to do anything extra. Just make sure you've lodged your tax return. These two tools alone, used consistently, can add tens of thousands of dollars to your retirement balance thanks to compound growth over time. And one more thing. Kill your high-interest debt first. Credit card debt. Buy now, pay later. These are silent wealth destroyers. Use the avalanche method. List your debts from highest interest rate to lowest. Throw everything extra at the top one. Minimum payments on the rest. When it's gone, roll that repayment into the next debt. It's the fastest, cheapest way out. Section 3. Earning $50,000 to $100,000. The leverage zone. Welcome to what I call the leverage zone. You've got enough income to make real moves now, but you're not yet in the brackets where the advanced strategies kick in. This is the income range where most Australians either accelerate their wealth or completely waste their potential. The difference? One word: salary sacrifice. Here's how it works. Instead of receiving all your pay as take-home income and getting taxed at 30%, you redirect a portion of your pre-tax salary directly into your super fund. Inside super, it's only taxed at 15%. That's literally half the rate. 3 notes lost to 30% tax versus 1.5 notes at 15% super tax. For 2025 to 2026, the concessional contributions cap is $30,000 per year. And that includes the 12% your employer already puts in. So, if your employer contributes $9,000, you can salary sacrifice up to $21,000 more, your sacrifice pile, before hitting the limit. But here's the detail most people miss. If you didn't max out your concessional cap in previous years, and your total super balance was under $500,000, as of June 30th last year, you can carry forward those unused amounts for up to 5 years. In a single year, you could potentially contribute well above $30,000 and claim a much larger tax deduction. This is completely legal and massively underused. If you haven't bought a home yet, this income range is also perfect for the First Home Super Saver Scheme. You can make voluntary contributions of up to $15,000 per year, $50,000 total, into super, then withdraw those contributions plus earnings as your home deposit. The tax savings on the way in make this one of the most effective deposit building tools available. And start investing outside super too. Even $200 a month into a diversified ETF like VAS or VDHG, held for 15 years, compounds into something serious. You don't need to time the market, you just need to start.
Section 4. Earning $100,000 to $150,000. Reduce, redirect, repeat. At this income level, you're sitting in the 30% bracket and creeping toward 37% at $135,001. 100 Australian dollars green notes, Melba/Monash, neat bundle in hand. Every dollar you can legally remove from your taxable income is now worth real money. Salary sacrifice is still your best friend here. Max it out. But now you need to get serious about deductions. Work-related expenses, self-education costs tied to your current job, home office expenses if you work remotely. These aren't glamorous, but they add up, and they directly reduce the income you're taxed on. Here's one that surprises people. Private health insurance becomes a financial decision at this income level, not just a health one. If you earn over $101,000 as a single, or $202,000 as a couple, and you don't hold private hospital cover, you'll pay the Medicare levy surcharge on top of the standard 2% Medicare levy. That surcharge starts at 1% and goes up to 1.5%. In most cases, a basic hospital cover policy costs less than the surcharge itself. So you're actually saving money by holding the cover. Check your numbers. This is also where investment structures start mattering. A share portfolio or negatively geared investment property can be powerful at a 30 to 37% marginal rate. When your investment costs exceed your rental income, that loss offsets your taxable income, and the government effectively subsidizes part of your investment. And one rule that too many people ignore: hold your investments for more than 12 months. Stack doubles after 12-month calendar visual. Do that, and you get a 50% discount on capital gains tax. Sell too early, and you pay double the tax you needed to. Timing your sales is one of the simplest, most overlooked tax strategies in Australia. Section 5. Earning $150,000 plus. Every move must be deliberate. Now we're in serious territory. At $190,001 and above, large spread across desktop, nearly half swept away, the government takes 47 cents of every extra dollar you earn. That's not a tax rate, that's a problem that needs solving. At this level, reducing your taxable income isn't optional, it's essential. Maximize your concessional contributions. Hit the $30,000 cap every single year. Use carry-forward provisions if you have them. And if your partner earns less than you, look at spousal super contributions. Contributing to their fund can trigger a tax offset of up to $540, while balancing your household's retirement savings at the same time. Beyond super, high earners should be looking at investment bonds. These are taxed internally at a maximum of 30%, lower than your marginal rate, and become completely tax-free after 10 years. If you follow the 125% contribution rule, that's a decade of compounding with zero tax on exit. Family trusts can distribute investment income to family members in lower tax brackets, though they come with compliance costs and setup requirements, so run the numbers with an accountant before going down that path. And don't overlook franking credits. When you invest in Australian companies that have already paid corporate tax on their profits, those credits flow through to you, reducing your personal tax bill or sometimes generating a cash refund. But here's the single biggest trap high earners fall into: lifestyle inflation. Earning $200,000 means nothing if you're spending $195,000. The only number that actually matters is the gap between what you earn and what you keep. Set a savings rate target of at least 20 to 30% of gross income. Automate it before you can spend it, and let time do the heavy lifting. Close. Here's the truth that holds across every income level. Wealth isn't built by earning more. It's built by keeping more of what you earn and putting it to work in the right places. The strategies change as your income grows, but the discipline, that stays the same. Whether you're earning $45,000 or $450,000, the gap between where you are and where you want to be is closed by one decision at a time, made at the right income level with the right tools. If this helped you out at all, smash that like button, chuck it to a mate who needs to hear it, and hit subscribe so you don't miss what's next.